Hi everyone, I'm Paul and welcome to my review of lesson 35 and 36 of ICT's 2022 Mentorship Program. Today's video is going to be last of the 2-for-1 episodes where we're going to be looking at trades that ICT took on the 26th of May and the 31st of May 2022. But before we do, if you enjoyed today's video, it would be great if you could like it because that helps other people to find it. And if you haven't already, make sure you subscribe to my channel and turn on notifications so that you never miss an update. These are quick, easy and free ways for you to support my channel. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then click the link in the description where you can subscribe to my free weekly newsletter and to join our Discord. Now that that's out of the way, let's jump into today's video. Today's video is going to be a review of lesson 35 and 36 of ICT's 2022 Mentorship Program. And our outline for today's video is we're just going to go through two trade examples that ICT went through in both of those lessons, which was a trade on the 26th of May and a trade on the 31st of May, both of which were in the AM part of the New York session. So we'll start today's video by looking at the daily chart on the ES or the S&P 500. And what you can see from here is that in the recent price action, we've taken out the sell side liquidity, these relative equal lows down here. And this was after we traded up into the highs and just into this volume imbalance here. You can see the market reacted quite strongly to that. We got this displacement down, which created an imbalance. And the market's now started to trade back up into that and has pretty much filled in that imbalance. So what we'd be expecting from here, and this is as we go into that session on the 26th, so this is the 25th of May here, is we'd expect price to start to draw in to this bearish order block here. So you can see we have this bearish order block here, which is an up close candle before the down move, which has an imbalance in it. Now, ICT goes through a little bit more detail on order blocks in this particular lesson, which is lesson 35, and he refers to the areas of sensitivity on the order block as being the lows, so we're obviously looking at a bearish order block, the open, and then the mean threshold, which is basically the center of the candle. So if we were going to draw that out, we would just take our fib and we would just run that from the high to the low. And so if we wanted to draw that out in time, it would look, something like this. And so what we'd be expecting is for price to draw into this level, and it would just be a matter of how deep into that order block that price would go. So let's just click forward a day and just see what the session actually did. And so you can see it happened exactly as we would have thought. We've gone into that order block, but we've actually gone quite deep into the order block and gone past that mean threshold. And so based on that transition through that mean threshold, that gives it a higher probability that the market will continue to trade higher. And if we're looking at the next draw on liquidity to be higher, we'd be looking at this buy side liquidity above this candle here, and then obviously into that volume imbalance that just resides above that. So let's just click forward now and just see if that's what actually happens or not. And you can see it most definitively does. So we get quite a strong reaction from that. You can see we take out that buy side liquidity and we completely fill in that volume imbalance. So let's zoom down to our 1 hour chart now and have a look at the price action on the 26th and start to frame the trade that ICT took in that AM part of the session. So we're on our 1 hour chart now. What we're really trying to show with this part of the video is how these subsequent sessions were all bullish, and you can kind of see from the price action here. So we come down, we take out the sell side liquidity, relative equal lows down here that we talked about on the daily chart. We have our bearish order block up here, and we also have that volume imbalance up here. So you can see as the market trades down into those relative equal lows, we get a reaction from that. We break market structure, trading up into these imbalances here. We get a gap, we trade back down again and up, and you can just see over the course of these sessions how the down close candles act as support and the market just continues to trade higher. Now in these ones that I've marked out here, you can see our dealing range. So that's our swing low to our swing high, and you can see how after we've exited that dealing range, the market then comes back down below that equilibrium level, below the 50% mark, so into a discount, which is where obviously we'd want to be buying. And you can see there's a bullish order block in this particular example. We then create our next dealing range, so from low to high, and you can see each time obviously we're getting a higher high and a higher low across this part of the price action. And again, we come back down, we trade into a discount, so below that equilibrium level, and this time into a bullish fair value gap. So you can see we have that here. We trade into it a number of times before the market again trades higher. So we come through this buy side liquidity, and again in our dealing range, so from the low to the high, we trade back down into a discount. This time the bullish fair value gap is actually at our discount level, so across that 50% mark. You can see again we trade down into that, we trade higher again, and this is coming in now to the 26, which is where we're going to be looking at the particular trade that ICT took. It doesn't actually take out these highs. We create relative equal highs, so we just match the previous highs before trading down lower as we come into that 9:30 open, and then the market takes off and attacks that buy side liquidity and that volume imbalance here. So if we're actually going to be marking this out in real time, so for example, say if we'd taken out this sell side liquidity, the market's traded higher, we've painted this swing high up here, we just mark out our dealing range. So from the swing high down to the swing low, so you can see this is now our dealing range. The market's traded up and then back as we've come out of the dealing range. We come back down into that 50% level, so down into a discount. And you can see in this example, we've got this bullish fair value gap just here. We trade right down into the mean threshold of that, about 50% before the market reacts. So that's how you would use, your dealing range to predict your, entry location, and how you would create confluence with that dealing range and then your particular setup. So we've zoomed into our 15-minute chart now, and we're just looking at the same pieces of price action, so across these sessions. And we're not really looking at anything different. All we're looking at is basically those same principles, but on a lower time frame. So you can see on that first dealing range that we just marked out, we had that bullish fair value gap on the hourly. And then obviously as we come down into a 15-minute chart, we're just able to get a much tighter entry. So you can see we have a bullish fair value gap here on the 15, which is obviously confluent with that 1 hour fair value gap. And you can see how the market trades back into that. So we're still using the same dealing range and then the same principle of trading back into a discount and then looking for our long setups within that range. And then the same goes for this particular dealing range here. So we have the swing low to the swing high just up here. Market trades back down into a discount. And again, we have that bullish order block from the 1 hourly. And then there's actually a 15-minute fair value gap down here as well. And one of the things that's quite interesting about this just particular setup here, if we zoom in, you can see we have an opening gap back here, just here from the Friday. And if we drag that forward, you can see how the market, has used this almost like as support. We've bounced off it. And then when we finally came through it, we sliced through that. And then you can see this fair value gap here that we've created on the 15-minute chart basically matches that opening gap almost exactly. So this is just another one of those examples that gives credence to ICT's view that the market is algorithmic. So you can see it's almost exactly the same, and as he'd often say, it's probably just random. But regardless, as we continue to look forward and we look at these dealing ranges, we just have that same concept repeating again. So we have our dealing range mapped out, we trade back into a discount, and we have those confluent entries or confluent setups on the 1 hour and the 15-minute chart that we can see lining up there, and then the market reacts to those, and then again we come back into those zones, we get those confluent entries, and the market continues to trade higher. Now as we come into the session on the 26th, so this is the one that we're going to be looking at the executions on, you can see we have this opening gap which we can extend out from the Monday. And then as the markets come into that session, you can see we've created these relative equal highs. So this particular run up here didn't take out the buy side liquidity here. It just created more relative equal highs before dipping back down into that opening gap, and then also into this bullish fair value gap that we created back here. And then you can see as we start to come into the morning part of the session, we get that swing upwards, which takes out all of that buy side liquidity, those relative equal highs, before the market pulls back down into this order block that we created here on the 15-minute chart. You can see we get a swing up and back down again as we go into the 9:30 open, and then the market takes off, trading quite deep into that bearish order block before running up into that volume imbalance. So let's look now at the executions on the lower time frames. So we're looking now on our 5-minute chart, and we're looking at the period just before we go into the 8:30 open. So we have our midnight open here, the market runs up. So this is where we created those relative equal highs. So we didn't take out that buy side liquidity. We just matched the existing level where the buy side was residing before the market pulled back. We swung up again, and then it wasn't until we were going into 8:30 that we took out all of those relative equal highs, that buy side liquidity here, before we traded back down towards the opening rotation. So one of the things that ICT notes in the video is this particular move here. So this is obviously outside the model because the model talks about the New York Open, and so this would obviously all be before the New York Open. But ICT's point is that the model is actually transferable throughout different parts of the session. That's just the ideal setup is obviously in the New York Open. So this particular part that we're looking at here from this high to this low, this is obviously one dealing range. And the point that ICT makes is that this whole price movement actually just happens in one move. So you can see it just moves down in one distinct move, and then the retracement back up into the level actually is in two moves. So we have one move and then a consolidation and then another move here. So basically, because we have the two moves, this is actually our dealing range from here to here. So from this swing low to this swing high here, we wouldn't include this part of the move in our dealing range. So if this is our dealing range from here to here, our 50% level would be around there somewhere. The market's traded back down into that discount part of the market, and we have our bullish fair value gap just there. So you can see how the market has traded back into that discount part of the dealing range and then reacted to that zone before then trading higher, taking out the buy side liquidity here and here. So if we shift the market forward now, so we're looking at pre 7 o'clock, and now we're looking at this period between about 7 o'clock and the opening rotation at 9:30. You can see if we cast our dealing range from here to here, then that's obviously our 50% level around here, and you can see the market trades in and around that. It comes down into a discount, and we have our bullish fair value gap here, which is confluent from the order block that we were talking about earlier in the video, and you can see how the market trades down into that at 8:30. We obviously get a reaction. There's some volatility here before the market trades back higher, goes back up into a premium before coming back down into a discount, and you can see after that 9:30 or around that 9:30 period, there was another few opportunities to enter off this bullish fair value gap and the bullish order block that were confluent in this zone before the market then takes off and trades higher up into that bearish order block and towards that volume imbalance from the daily chart. So we're still on the 5-minute chart and looking at the period just at the open, so at the 9:30 open. And I think one of the things that's important to note here is that how we ensure that our entries are as high probability as possible is we're always looking to stack as much confluence as we can. And then the other thing that ICT layers on is the SMT divergence, so the smart money technique. And so in this example, we can see that the ES, so we're obviously using the lows to compare in this example. So you can see that the low that we have here on the ES is lower than this one here, whereas on the NQ, on the NASDAQ, this low is actually higher than this low here. So what this tells us is that the ES is the relatively stronger of the pair, and that's because the ES is actually accumulating long positions, where the NASDAQ is actually stopping people out. It's actually taking out that sell side liquidity. So again, this is another indicator that's just adding another layer of confluence for our entry going into that 9:30 open. And you'll see here in orange that we have this 4,000 level mark. So that was actually the price that ICT was calling out in Twitter as we were going into this session as his sort of target or his initial draw for liquidity. So we're back on our daily chart now, still on the ES, and we're looking at the session on the 31st. Now, the thing that's worth noting about the session on the 31st is it's just after the long weekend. So I think it was the Memorial long weekend. So we had that Friday session that we tracked in the first part of the video. So we took out the volume imbalance and the buy side liquidity, And you can see as we've come now into this Tuesday session, so the first one back from the long weekend, the market's traded higher before pulling back, and we've had this, kind of consolidation. So we're going to zoom in now to the 1 hour chart and start framing up the trade that ICT took on the 31st of May. So we've zoomed in now to our 1 hour chart, and what we're looking at is that sort of long weekend worth of trading. So you'll recall, if you watched the video, ICT didn't partake in any of that session on the Friday. He tends to step away from the markets when we go into these long weekend periods. We obviously have Sunday, and then we come into Monday, which is a shortened session for Memorial Day, and then we're looking actually at the Tuesday, which is where the trade that ICT took is. So this is quite simple actually. If we run our fib from the swing low to the swing high on this whole move, so this is creating our dealing range, which we've been talking about in the last few videos. You can see the market then trades back as we go through the Monday, and then into Tuesday we come back into that volume imbalance from our daily chart, and we're now in a discount, so we're below that 50% or equilibrium level. And you can see down there we've got our bullish fair value gap, so our 3 candles set up here on our hourly chart. And if we drag that across, you can see how the market on Tuesday, as we come into our 8:30 and 9:30 open, that the market trades down into that, and then we react strongly from that level. Zooming in further to our 15-minute chart now, and we're just looking at tightening up that sort of area that we're focusing on. So we still have our dealing range, we have our fair value gap, our bullish fair value gap from the hourly, but you can see now that we're using the 15-minute time frame, we've actually got more granular data, and we can see that there's actually another bullish fair value gap which is confluent with that fair value gap from the hour, and you can see how neatly the market trades into that before we react. And we've just started now marking out our buy side liquidity and sell side liquidity, and you can see clearly how the market trades into that fair value gap, that bullish fair value gap on the 15-minute chart. We react to that, and then we start to attack this buy side liquidity just here. So we've zoomed into our 5-minute chart now, and if you look at the price action, you can see just after 9:30 here, this is that dip down into that 15-minute bullish fair value gap that we were talking about a little bit earlier in the video. The market then trades higher. We come into that period just before lunch, we get a little bit of a consolidation, and then the market trades away. And so if we look closer, we can actually see that there's a setup using the mentorship model on the 5-minute chart right here. So you can see after we come and take out this liquidity here, we get this run from here to here. So if we created our dealing range using that swing low and that swing high, our equilibrium level would be around here, and we have a bullish fair value gap right here. And you can see how the market very neatly trades back into that before reacting and trading higher. And then we obviously are targeting the buy side liquidity that we have up here. So you can see we have all the elements that we need in terms of our model. So we have our break-in market structure just here. So after we've taken the liquidity, we get an expansion upwards, we get that displacement we're looking for, we get a shift in market structure or a break in market structure here. We have our dealing range, we come under that 50% level or into a discount, so below equilibrium. We have our model set up, so we have a bullish fair value gap here which the market trades into, and then the market trades away, targeting that buy side liquidity above these older highs just up here. If we look specifically at the trades that ICT took in this session, he actually took trades in 2 different parts. So he took them just around 9 o'clock. So that's this price action here. So that's before that swing we had higher as we went into 9 o'clock, before that rip downwards. We had our bullish fair value gap get created just around here on that 5-minute chart. And you can see ICT entered just around these levels here before the market traded higher and obviously exited out here. So one entry here and an exit here before the market pulled back, and then another one here as we consolidated just before the lunch period, and then an exit here just as we went into lunch. So that was quite a short trade. So one of the things that's worth mentioning again that we've seen, and this is the second time we've seen it in the lessons, is that even though we get this fake move to the downside here, the model actually doesn't trigger. So we don't see the 2022 mentorship model actually trigger an entry for this short position. So it's actually keeping us out of the market. It's not actually putting us into these false moves. So we know that the move, or the real move later, is going to be to the upside. This is due to swing in the opposite direction, and the model doesn't trigger an entry on the 1-minute chart for us to go short. So that's just something that's worth noting from this particular piece of price action. And so if we just focus specifically on the trades that ICT took after that 9:30 open, that's these ones just here. So that's that run up high that we were talking about. This was that fake move to the upside at 9:30, and we get that big swing down, which takes out the sell side liquidity, and we actually trade down into that 1 hourly fair value gap and that 15-minute fair value gap down here. So you can see in this particular move, we have a swing high here. We then take out the sell side liquidity before reversing. We get our market structure shift here, and then the market consolidates higher. We trade up into a bearish fair value gap just up here. You can see the market reacts to that. We take out this buy side liquidity here before trading back into this area. And so this is an area where we have that 5-minute bullish fair value gap that we marked out earlier. And you can see we also have a confluent fair value gap here on the 1-minute chart as well. So as we come back into this level, and you can see that ICT's marked out here, is once this sell side's been taken here, so once this sell side liquidity's been taken here by this move, is that we then have a free run all the way up to the buy side liquidity up here at 41.4350. And so this is precisely what ICT does. So you can see he takes his long positions here, so 5 contracts at 41.20, and then exiting as we hit this buy side liquidity here into trades just there. So again, this is another example of just using confluence to build a high probability trade. So we're trading in an area where on the high time frames, we know that we've taken liquidity and we've seen a reversal. If we've zoomed down now to our 1-minute chart, you can see we have our dealing range from this swing low to this swing high here. We have a 5-minute bullish fair value gap, a 1-minute bullish fair value gap. We've now traded back down into those two areas, which is in a discount or below that 50% equilibrium level. So we know we're buying in a discount and we're using those long setups, and then we're targeting, liquidity that we know is residing above an old high just here. Thanks for watching my review of lesson 35 and lesson 36 of ICT's 2022 mentorship program. Today's video was the last of the 2-for-1 episodes as we approach the end of the 2022 mentorship program. I hope you've enjoyed watching these breakdowns of the trades that ICT's been taking, and I hope that they've been helping you to consolidate your learning. If you did enjoy the video, it would be great if you could like it, because that'll help other people to find it. And if you've enjoyed this content and you'd like to see more videos like it, then make sure you subscribe to my channel and turn on notifications so that you never miss any updates. And remember, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description, which allows you to subscribe to my free weekly newsletter and to join our Discord. Thanks for watching, and I hope to see you next time.